Good morning and welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we've been talking about common questions that I get regarding retirement accounts, and we left off with talking about when do you take withdrawals and how much do you have to take, how are your IRA withdrawals taxed, what happens, how does my IRA fit into my overall plan, understanding how retirement accounts are a big important part of your planning, but it is just that too. There are other factors that come into play. What happens to your IRA when you die? How does succession work on that? And what kind of strategies can be employed to maximize the benefits there? How can you minimize taxes, both of those go hand in hand. And then, so what we're going to do today, all right, in addition to answering these questions, is we're going to, as I've been helping you with some of this stuff regarding your retirement accounts, we'll start with some basics there. And I'm going to, through that, share some strategies with you. So let's look at traditional IRA basics, all right? Contributions, if it's to a traditional IRA, are tax deductible or may be tax deductible if, within certain guidelines there. Grow tax deferred while inside the account. And when you take money out, that's going to be taxed at your highest, basically whatever amount you're taking out of your IRA gets added to your income, and most likely it's going to be part of your, you're going to be paying tax on it unless you've got really low income. All right, so let's begin with traditional. Again, understanding this contribution being tax deductible and also the limitations about these IRAs with regard to contributions. So for instance, in 2019, for this year, if you're contributing to a traditional IRA, now you may have a 401k at work, and depending on certain income levels, you can still contribute to an IRA as well. And if you've got an at-home spouse, you can contribute, you can use that household income to contribute to an IRA for them as well. And on the limitations, whether traditional or a Roth, by the way, on this one, it's $6,000, and if you're over 50 or older, you get an additional $1,000 catch-up contribution for a total of $7,000 that you could contribute to a traditional IRA or a Roth IRA for each of you. Okay, so for a couple, there you go, $14,000 contributing, plus, like I said, whatever you're putting into a 401k. Again, there are certain income limits, so you want to get with your tax professional to make sure that you're hitting those guidelines to be able to get the benefits that you're looking there. One of the things when it comes to understanding this next slide, there was an article in the Detroit Free Press, baby boomers understanding how important these rules are. So studying IRA rules can be so important. And this talks about understanding how these things work. So one of the biggest things retirees need to recognize about their IRAs and 401ks is that eventually there's going to be required minimum distributions. And the magic number, as I talked about many times on the show, is 70.5. So that's the number that should trigger a close look on how much you need. Now, there are some exceptions, ways to work around this too, and you need to understand how those might work. For instance, at 70.5, right, the year in which you turn 70.5, that doesn't mean that you've, down to that day, oh, there's my 70.5 birthday, I got to take that money out that day. No, 70.5 simply means within that year. By the end of that year, you need to take your required minimum distribution. Now, there's an exception to that rule in that first year. So at 70.5, and that required minimum distribution, by the way, there's an IRS table, we'll get into that in a moment, called the Uniform Lifetime Table, that has factors to show you what that needs to be, how much you need to take out, and how you do the math on it. Your custodian that has your IRAs will help with that. They will, most custodians will do that, calculate your RMD for you and arrange to help you with that. And your advisor, when I'm doing reviews with my clients and we're coming up on that age, we're sitting down and we're going over all the different options for them. We set it up to where, what is best for them. And typically, an example would be, we'll have those required minimum distributions paying out on a monthly basis with taxes withheld, so there's no surprises at the end of the year there, and we calculate their tax rate so we know how much to withhold And at the same time, we typically set it up to be automatic, so we don't have to, worry that we're going to forget, or that they get, they're out of town, or, or maybe go through some kind of extended illness. You don't want to have these things hanging out there and because the penalties are so high if you miss that deadline. So we just get them set up automatically, and then the custodian will recalculate at the end of every year and just adjust the payments for the upcoming year to make sure you meet those IRS guidelines and avoid that 50% penalty. That's a big reason for getting it set up this way. And there's an article in the Detroit, let's get that slide up, the Detroit Free Press here talks about Susan Tompor, baby boomers must study IRA rules. Older baby boomers need to pay attention to deadlines because, again, of this big 50% tax penalty is what they're talking about there. None of us want to have to worry about. And one of the things about RMDs is that you don't get, the government is not going to, the IRS isn't going to send you any kind of notice. Ideally, your custodian will. Okay, they'll send you a letter saying, hey, it's about that time. But don't, here again, ultimately it's still your responsibility. If you don't get the letter, if something, whatever, some glitch and it doesn't get to you, or they didn't send it, or whatever that may be, it's still your responsibility. And because from the custodian, they have no responsibility on that. If you don't take it, it's not on them, it's on you. You're the one paying that 50% tax penalty. And here's something to understand about that, by the way. You can have multiple IRAs. So if you got multiple IRAs or retirement accounts, maybe you got money still at the old employer that you've retired from, that you're taking that you need to take a required minimum distribution from as well. Custodian doesn't know where all your money is, or if you didn't, maybe you took money from another account and that met the required minimum distribution on the account they have. So you could have 5 different accounts, but maybe take the required minimum distribution from one of them, enough money out of distribution from one that meets the required minimum distribution of all. There's a lot of, again, planning strategies and investment strategies that come to play here. So when it comes to taking those RMDs, again, it's up to you. Now, let me share a strategy. We can go ahead and get rid of that slide. One of the things about RMD is understanding that, right? IRS is wanting to get paid. You've had this money growing tax deferred for long enough in their mind, and they want to, the laws are passed to make this a time when you have to pay it. Now, that 70.5 birthday I told you about, you have until the end of that year. Now, there is an exception to that rule. And what it allows is if you can potentially go in your first year, so the year you turn 70.5. So let's say this year, you turn 70.5 in 2019. That means you have until the end of this year to take your required minimum distribution. Another reason, by the way, to do a review with your advisor to make sure that that's set up properly. But there is an exception to the rule that says you can wait potentially until April 1st of next year. As long as you get that RMD out by April 1st of next year, there's no penalty. Now, from a planning perspective, depending on the size of the RMD and other income considerations and what your tax situation is going to be, there could be a time when it might be better to do that. All right, and not have that RMD this year, and it may help minimize your taxes this year in doing so. However, here's the key, is that means next year you have until April 1st to take that RMD, and then you will have to take a second RMD for 2020, right? So your 2019 RMD, required minimum distribution, you have to get out by April 1st of 2020. Then for your 2020 required minimum distribution, you have until the end of the year to take that out. Now, as an example, I'll give you where this could be a strategy you may want to employ. So let's say that when you take your required minimum distribution this year, that if you didn't take it, maybe it would reduce taxes overall. Of course, you're not going to pay tax on it, right? And let's say you were in a 12% bracket and you were only going to be paying 12% tax on it anyway, and your Social Security was negatively impacted if you took it this year, would cause some of your Social Security benefits to be taxed. Whereas if you wait till next year, and even though you're taking 2 RMDs, let's say you're still in the 12% bracket even with both of them, well, there's a reason then, right, that you're not going to pay any more tax. The tax rate's going to be the same, and depending on the impact on your benefits, we would weigh all that and see, well, which one causes you to pay less tax over the 2-year period. and that's the way you would then determine which one to do. So again, there are strategies to be employed when it comes to those RMDs. All right, we're going to talk more about RMDs. I'm going to take a break, but when we come back, why, the whole thing about RMDs, and why this is so important, how you can use it in your planning, how you can minimize taxes, how you can look forward to the time. So if you've got, another 10 or plus or minus years until you have to start taking RMDs, or even if it's just a few years, there may be some strategies we employ to minimize the amount of RMDs, thus minimizing taxes in the future. All right, this is one of the areas anyway. We're going to talk about that and more. Join me here. We'll be right back on the Retirement Report.